Ladies and gentlemen, thank you for standing by and welcome to the AGS Sale Investor Presentation. At this time, all participants are in a listen-only mode. There will be a presentation followed by a question and answer session, at which time, if you wish to ask a question, you will need to press star 1 on your telephone. I must advise you that this call is being recorded today, Thursday, the 21st of December, 2017. I'll now turn the conference over to our first speaker today, Mr. Dennis Barnes. Thank you. Please go ahead.
Well, good morning, everyone, and welcome to the call for us to talk you through the nature and the rationale of the transaction to sell our Ahuroa gas storage facility. Now, you should have a presentation in front of you. The first page is a picture of the facility, or the bit on top of the ground, and there's a bit of a fraud on the front page because although Graham and I are listed both alphabetically and hierarchically, Graham did a lot of the heavy lifting on this transaction, so I'd just like to recognise that up front. Thank you. But what I will do is I'll talk through and I'll reference the slide number I'm on as I talk, and then we'll come to questions at the end. It's pretty straightforward, so I'll go reasonably quickly. Obviously, page 2 is our normal disclaimer. Page 3, what we're going to talk about today, what was our rationale, the deal itself, what it means to the accounts, and when we expect the deal to complete. A little bit about the future commercialisation of Ahuroa gas storage, and just a little bit of history which I won't talk to, but may be useful for your background. So just on slide 4, a reminder of our highest level strategy, which is obviously primarily focused on delivery in the customer and generation businesses. But underlined on that slide, you can see that we always have an eye to optimization of our portfolio, and the sale and commercialization of Ahuroa gas storage is us delivering on that optimization, and I'll take you through why we think that's the case. But first, on page 5, the highest level transaction details. So last night we signed an agreement to sell the facility to Gas Services New Zealand. They're associated with First Gas, and Gas Services New Zealand is a provider of services to First Gas and other customers who operate one of the largest or the largest pipeline system in New Zealand. One of the appeals for us, of course, of selling to an operator of that pedigree is that they are a specialist in these type of assets. So as the facility is further expanded and as we continue to take services from it, we've got someone who's really skilled in this activity. And it allows us to focus on our core activities of customer and generation. Of course, we've entered into an agreement with GSNZ over a 15-year period. It's an agreement which supports our needs, which are slightly less than the current capacity of the facility. We'll, for a few months, provide services to GSNZ to transition. The sale price is $200 million, cash on completion, and we expect to pay tax of $48 million. We'll apply the net proceeds to debt. The tax we pay will, of course, create additional imputation credits, which on the targeted payout for fin year 18 of 32 cents would allow that to be fully imputed. One of the strong rationale drivers for us on the commercialisation of gas storage is that we believe that it will be increasingly important in a world where transitioning to a lower carbon future requires the thermal supply to be more flexible. So we have committed to an early expansion of the facility. And in terms of timing, the GSNZ have 120 days from now to put forward a proposal on what that would look like, and we go into a little bit more detail later. And then 2 years from when that proposal is accepted, we would expect to have an expanded facility. So in terms of accounting, we have got unaudited clearance from our auditors that the treatment of the storage services agreement and the sale of the facility will be treated normally from an accounting perspective. So sale of an asset and the gas storage service payment will be akin to a transmission payment and go as a cost of goods in our accounts. Unfortunately, Standard & Poor's hold a different view, and that the storage services agreement and payment is a lease. So it will have no impact on the debt level from a Standard & Poor's perspective, other than obviously we'll pay down some debt. We'll have a lease added to the balance sheet from a Standard & Poor's perspective, but it's got an immaterial impact on the debt to EBITDA ratio and doesn't affect our BBB rating. Now, longer term, and I'll come to it later, it may be that with other customers on the gas storage facility, Standard & Poor's may choose to change their view. And they will issue a note today or shortly thereafter on their view of the transaction. So on page 6, why do we think this creates value for Contact shareholders? 4 areas. The first one being that the capacity we don't use should be more valuable to a third-party customer. We believe that GSNZ are a higher value owner, a lower cost of capital than Contact, and able to provide operation alongside their Taranaki operations, and as I've mentioned, a specialist in gas infrastructure operations. We tested that case with a limited market process, and we're very confident that GSNZ is the highest value owner. We believe the gas storage costs will come down. The expansion reduces the cost per unit of storage. We're convinced that this facility will be expanded over time, so reducing our cost per unit is important, and our share will decrease over time. And connected to that, we believe GSNZ, as an independent commercial owner of gas storage, will be more able to sign up third-party customers than Contact, who inherently, in some third-party customers' eyes, have a conflict because we're involved in the downstream business. On page 7, given all of that strong strategic rationale, we still believe that retaining a service from gas storage is required and is competitive. As you know, the gas storage facility manages the competing incentives of gas producers who want to produce gas in a flat, stable manner, and the electricity market, which, as a result of hydrology, is inherently intermittent. It's one of the few scale providers of that flexibility. The hydrology in New Zealand requires thermal to flex by between 40 and 50 petajoules per annum. And we believe that right now, and probably for many years to come, newer distributed technologies cannot compete at scale with this type of flexibility provision. We've entered into an agreement for 15 years because we strongly believe that it's a competitive supply for at least 15 years and probably more, but we've left any period after the first 15 years open to a callable option at our right. The key transaction terms on page 8, talk to most of them. Sale price of $200 million, all cash on completion, and we're targeting end of financial year. The dynamics change a little bit on expansion, and I've told you that that's somewhere between just over 2 years away and now. The Net cash proceeds after some small transaction costs will be paid to debt. We get a small gain on the accounting book value. We maintain the current capacity of the facility, but our share of the use of the current capacity drops to 75%. So there is capacity available for sale by GS NZ. And then once expanded, our percentage share reduces slightly, but our absolute capacity increases. If and when third-party users contract for services, whether in its unexpanded or expanded state, Contact receives a rebate on the fees it provides. We're not going to go into the detail on the nature of that rebate because we believe that's negotiated in public with third-party users. But suffice to say that if third-party users fully contract the spare capacity once expanded, our payments will be less than the $20 million a year, which if you come back to one of our original comments that our rate of storage services comes down, that's how the mechanics will play out. You may ask yourself why $20 million? And we've tested that on a number of fronts. One is we provide some services from gas storage today. So for example, we're currently buying gas over the summer with an obligation to return in winter. And the summer purchase price is lower than the winter sales price. And that spread is effectively the storage services premium. And that aligns with a rate of $20 million a year. First Gas have tested this seriously. And at the unexpanded level, First Gas get a return, but their returns increase on expansion. So they're highly motivated to make sure that the expansion sales or any current sales by them are market competitive because their returns increase. And then we've thirdly done an assessment of other potential storage types, whether it's coal stockpiles or offshore flexibility in production. And we see this as competitive. So we've come at this at a number of angles to give ourselves comfort that the rate we're paying is competitive. On page 9, we go to the, what you need to put in your spreadsheets. We've already said that borrowings will come down 151 million. EBITDA will reduce because the storage service payment becomes a cost of energy. It doesn't reduce by $20 million because we avoid the $6 million of operating costs that we currently incur for the facility. Slight increase in earnings per share given the reduction in interest and depreciation is greater than the decrease in EBITDA. Free cash flow, immaterial change, allows us to fully impute the targeted 32 cents per share for fin year 18. And as I've mentioned before, there's a few moving parts in this calculation, but the credit metric as defined by Standard & Poor's substantially unchanged. And Matt will be able to give you the maths on what our effective balance sheet increase is in Standard & Poor's eyes. But that EBITDA definition changes as well. But the zero-sum game is that it doesn't change very much. We believe that the financials will improve over time. Third-party sales will clearly have a direct financial benefit to us. It may trigger a change in treatment by Standard & Poor's, which our credit rating metric is the trigger for our revised distribution policy. The way the expansion is going to occur actually increases plant resilience and availability. There's more investment in above ground infrastructure. The facility is actually run really reliably, but there's a couple of single points of failure in the system and this helps remove those single points of failure. And of course the initial expansion to take us up to 65 terajoules a day in and out in our view, is an initial expansion. The facility on our previous analysis is more than able to handle 150 terajoules a day of in and out, which, if that were to be used in a gas peaker, that would provide up to about 600 megawatts of flexibility. So, of course, over time, we expect the initial expansion to absolutely happen, and then we are optimistic that it will go further than that over time. On page 10, there's a bit of a timeline. We're looking to complete by the end of June next year. Limited conditions precedents. First three being effectively government approvals. We're not expecting anything material in that. The sale of the asset makes it available at a lower cost and should be important in a lower carbon future. The purchaser is obviously an existing credible large player, and the initial expansion will drive some investment and job creation in Taranaki as it progresses. Some of you will be aware that the petroleum assets that underpin the gas storage facility received an accelerated tax depreciation treatment, and GSNZ will look to get a binding ruling from the IRD that applies to the asset, not the company. So that's a condition precedent. Again, we wouldn't be announcing if we thought that condition precedent couldn't be met. And the last CP is that there is one market player that has some limited entitlements to gas storage capacity, and they've just not decided whether they want to take those up yet. If they do, then it's all good because it's the first third-party involvement in the facility. So we don't see that as an issue if those rights are taken up. They are relatively limited. And the fifth precedent is actually the first one that will likely be satisfied. Just a couple of slides now, page 11 and 12. Page 11 is the marketing slide. So gas storage users, this is what's available to you now, and that will increase in 2 years' time. And we're not waiting for the transaction to complete for this to be open to commercial negotiations. And then just a little bit of history on the gas storage facility on page 12. And perhaps the only call out I'll make is one which is relevant for timing, which is, we took over operation of the facility just over 3 years ago from Origin, and we've materially improved the cost of running this facility and the reliability and safety and process safety performance of this facility. And clearly we wanted to do that to make sure that on sale, Contact shareholders were getting best value. Because the rationale for all of this has existed for a few years, but we wanted to make sure that we'd applied all of our best operational efforts to the facility first. So with that, I'll go to questions, unless Graham or Matthew want to add anything. They're shaking their heads.
Ladies and gentlemen, we will now begin the question and answer session. If you wish to ask a question today, please press *1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press the pound or hash key. Your first question today comes from the line of Baden Moore. Please go ahead.
Good morning, guys. I just had a fairly simple question. I was just wondering if you could give any colour on what the sticking points were for S&P to factor this in. Was it duration of your offtake contract that might have changed their treatment? And whether you're, just to be clear, are you on the hook for any contribution to the expansion of the facility in the future? And can you just confirm if you don't see increased utilisation of the asset post the expansion, does that mean, or declining, does that mean your costs will go up?
Yeah, so I'll take the second one first, and I'll have a go at the first one, and Graham may interject. So on expansion, we are on the hook for a higher payment. It is more than $20 million, and if no third parties were to use the facility, then we would be paying that fee for the full 15 years. Like I say, we're not going to disclose what those numbers are because it sort of ends up negotiating in public. If that were the case, then that's our downside case, and we're still happy to do the transaction. So yes, we will be paying more for the expansion. The rate is fixed. GSNZ are obligated on the delivery of the expansion, but the rate is fixed. And we're quite happy that if we were the only user, then that's a rate we can support. We don't expect that to be the case, though. The primary sticking point for S&P, which is sort of all of the above in your question, but the primary sticking point is we're the only user today. And the key to unlocking Standard & Poor's, I believe, will be a third-party user for term. So selling a 6-month deal won't do it, but if there was a third-party customer of GSNZ, then for term, then that would unlock S&P, I believe. And that's the primary concern, is third-party use.
That's great. Thanks, Dennis.
Just a reminder, ladies and gentlemen, if you do wish to ask a question today, please press *1. Thank you.
We've got one investor stroke analyst in the room, Neville Glewitz, and Neville has a question, so we'll take that one now while the other callers are thinking.
Actually, a few questions for you, Dennis. First one is just to know a little bit more about GSNZ. They're an associate of First Gas. Are they wholly owned? What's the sort of level of backing, revenue, and what kind of guarantees do you have in the contract with them?
Yep.
Next question is you've given us sort of the ultimate capacity of AGS. Any idea as to kind of rough guideline as to the capex involved in the stage 1 expansion that it looks like GSNZ are pretty much committed to, and what the ultimate capex cost would be to get to 150 TJs both ways? And sort of, do you see any benefit to yourselves in going from the 27 TJs a day to 45 TJs a day injection, sort of under the post-expansion world?
Okay, so I'll do the second one first. I'll let Graham do GSNZ. I mean, when we've talked about the facility prior to this transaction, to go from 2745, so I'll refer to that as being injection extraction, to go from 2745 to 6700 was around $75 million. And then to go to 150 was another 75. Now they're old figures. But if you were to, rule of thumb, go from today to 150, somewhere in the order of $100 to $150 million, probably towards the top range, then that's what our previous workings were. To go from 2745 to 65, which is the initial expansion that we're committed to, I'm just looking at Matt on the level of disclosure I can give on the capital associated with that expansion.
Yes, I think it'll be firmed up once we get to the once we get to the proposal date. Yeah, so it's in that range.
So it's in the pro rata range. Yeah. So so 25-30 million bucks would be the pro rata calculation.
25-30.
Yeah.
Okay.
And then your next question was, the third question was, when it's expanded and our share is 45, do we think we can use the extra capacity that we have. Clearly, that's going to be somewhat determined by the midterm future of thermal support to the market. So with a decision in 2022 around the recontracting of the Rankine units, then we believe that the then lower cost capacity gas storage facility can compete with that question. So we believe there's space for the 65 in the market, and we believe that it may be additional to our own needs to back our hydro production, but we believe that there will be a market to sell our share of 45 on at least the terms that we've agreed to.
Actually, can I just clarify one question on that? You've got access to sort of something like 13.5 PJs of storage there, which is still the bulk of storage.
Yeah.
If it went to 150 on sort of 4.5 PJs remaining to a third party, there's probably really not enough to exercise that. Are there other storage options nearby?
It depends how you use it, of course, Neville. If you think of the Iona gas plant in Australia, which is 500 out, its reservoir is only 20 to 25 petajoules. So it really is just a refill rate question.
So that doesn't provide you the longevity that, say, coal stockpile would.
Yeah. So there is I think the opportunity at the expanded level isn't as simple as a move 10 petajoules from summer to winter. I think it is much more of a trading capacity. Now, that will be subject to a whole heap of other economics to go above 65, but certainly up to 65, there's plenty of reservoir capacity to do seasonal shifting and short-term shifting. I mean, look at the situation today. You look at the current dry sequence, and you wouldn't expect to be extracting in December, and we are.
While we're on that subject, it's kind of a bit left field, but how do you feel about the current ongoing discussion about whether or not Genesis's gas contracts will actually support the current min zone calculations?
You mean should it be included in the hydro risk curves? Is that the same question? I mean, I think the industry as a whole is well informed on the availability of fuel to handle a very dry sequence, and the hydro risk curve is one input into that thinking.
But it understates.
Yeah, but I think to start to include gas storage levels and coal availability, because coal availability is, there's a local dimension and an international dimension. And how far do you go? Do you have to include assumptions as to what Methanex would sell their gas for in a dry sequence? So I don't believe there's a big case to have that all range of information managed in the same way as the hydro risk curves, because I think the market is informed as to the availability of thermal fuel to support a dry sequence. It's looking like it's going to stay dry for a while, but, famous last words. When's Mark Binn's official end date? Because the dry sequences seem to be associated with his tenure.
Great, no, thanks for that.
But yeah, I mean, I think there's plenty of thermal fuel around. You're just talking about where'd you get it from and at what price. Just on GSNZ, I mean, I could have a half-assed go, but
I think the way to think of it really is the unregulated arm of First Gas. First Gas clearly owns the pipes, which are regulated. It doesn't make sense to fold this unregulated asset into a regulated business.
So it's a wholly owned.
So it's wholly owned.
And in terms of any kind of guarantees going through,
so
obviously the parent.
We have a guarantee from the parent.
Great, thank you.
So we're done on the questions in the room. I'd open the line up again for any questions on the phone.
Thank you very much. Ladies and gentlemen, just a reminder, if you do wish to ask a question today, please press star 1 on your telephone handset. Thank you.
There is a question from Andrew Harvey-Green, who's struggling to get through on the question, but I will read it out via text.
Yeah, that's a good way.
His first question is, any variable components to the annual fee?
No?
No.
The second one is that he assumes only the dividend, the final dividend would be fully imputed, not the interim. The other question is, he says too long to text, so I don't know if you
I mean, we did move the interim dividend payment to April to give us the ability to fully impute that. Our expectation is that we will fully impute the interim, which, as a reminder, is 40% of the guided dividend for the year. And the reason to move it to April was because we pay tax in March, so that helps us do that.
At the end of March, the cash and credit balance, you have to be back at zero.
Yeah. Yeah, so we do expect to fully impute in April.
Okay, back to you, Christian.
Thank you very much. Andrew Harvey-Green, your line is now open for your third question. Thank you.
All right, thanks, guys. So
you can ask that long one. You can ask the one that was too long for text. Yeah.
I guess it's just around the fact that presumably you've been trying to get other players into the storage facility for a period of time, and yet you've demonstrating a bit of confidence that there'll be other third parties coming in. I just want to get an understanding of where your confidence is coming from.
Well, I mean, we have...
Put another way, what's the main reasons why people haven't contracted thus far?
Matt's writing some things down, but I can't read his writing. That's why I was pausing. Over time, we have actually had more use of the facility. So it has accelerated over time. And this last but one dry sequence and the current dry sequence have given us a bit more confidence that we can identify the rate at which participants are prepared to pay for services. And as you know, the oversupply of kit and water over the last 5 years has made it hard to see that. So we've done some deals which evidence the number. It's clear through those discussions that the participants, the current customers via Contact, are looking for comfort that they're paying a market rate, and they're paying a rate that's in line with what Contact is paying. And of course, we can't fully give them that confidence because it sits embedded in our portfolio. So we have had first-hand feedback from current and potential users that having a transparent, effectively posted price will give them more interest. And doing the expansion and bringing in a higher value owner actually reduces the unit cost of that provision. So, it's getting cheaper, so it should get more used. But it's a call, Andrew. This isn't a highly liquid posted market, so it is a call. But given the nature of the arrangements with NZGS, where, and I keep getting it wrong, First Gas, given the nature of the arrangements with First Gas, where they're incentivized from a return perspective to get more clients, we're incentivized to help them because we get a rebate. The structure is designed to aggressively go after those third-party users. But the simple answer is it's a call.
Yeah. Okay. Thanks.
Just another reminder, ladies and gentlemen, if you do wish to ask a question today, please press star 1. Thank you. There are no further questions from the phones at this time. I'd like to hand the conference back to today's presenters. Please continue.
Okay, well, thank you, everybody, for taking the time, and apologies for doing it on the day. You're probably starting to pack your cars up and put your shorts on, which is an unappealing thought for most of you. But, you know, we've got to do these things when the time's right. Thank you for dialing in. If you need any more detail, then clearly we're available to take calls, and we'll tell you how it's going in February at the half-year results. Have a Merry Christmas, and look forward to a great 2018. See you all then.
Thanks very much, everyone.
Ladies and gentlemen, that does conclude our conference call for today. Thank you for participating. You may now all disconnect.